Ever glance at the Nifty and just wish there was a simpler way, something to cut through the noise and show the main trend?
Oh, absolutely. It's easy to get lost to the daily ups and downs, isn't it? You want that bigger picture.
Exactly. And that's kind of the idea behind the super trend indicator. Think of it like a shortcut maybe
Yeah,
to spot the general direction. It's pretty popular for indices like Nifty.
it is. Yeah, its strength is really its visual simplicity. You see
Mm.
the line on the chart, and it gives you a pretty clear signal.
Right. So you get this line plotted either below the price or above it. Below means generally things are looking bullish, maybe a buy signal.
And above suggests bearishness. Maybe time to be cautious or look for sell signals.
But it's not just a random line, is it? It's actually calculated.
Correct. It's based on market volatility, which is key. It uses two main things. Average true range, the ATR that measures the typical price movement.
Okay, the daily swings, sort of.
Yeah, exactly. And then there's a multiplier. That just sets how far the super trend line sits from the price.
So it adapts. If the market's jumpy, the line gives it more space.
Precisely. It helps avoid getting shaken out by, normal volatility.
Okay, let's dive into this. Our goal here is to break down how you'd actually calculate it, step by step. We'll use a hypothetical Nifty example. Standard settings 10 for the ATR period, 3 for the multiplier.
Sounds like a plan.
Yeah.
So fundamentally, the super trend tracks below the price in an uptrend, potentially acting as a kind of moving support.
And above the price in a downtrend, like moving resistance.
Right. And these levels come from what are called the basic upper and lower bands. First, you find the midpoint for the day, just the average of the high and low.
Simple enough.
Then the basic upper band is that midpoint plus the ATR times the multiplier. The lower band is the midpoint minus that same ATR times multiplier value.
Got it. But the super trend itself doesn't just blindly follow these bands, does it?
No, and that's important. It has logic built in. It looks at whether the price closes above or below the previous super trend level to decide whether to flip, trying to smooth things out a bit, avoid whipsaws.
Okay, makes sense. So first step, we need data, right? Let's imagine we have 12 days of Nifty prices high, low, close for each day. We need at least 10 days for that initial ATR calculation.
Correct. And before ATR, you need the true range, or TR, for each day. TR is basically the day's volatility measure. It's the biggest of three values, current high minus current low, the absolute value of current high minus previous close, and the absolute value of current low minus previous close. It captures gaps, too.
Right, gotta account for those overnight jumps. So maybe for day 2, our TR is, say, 200. Maybe day 3 is also 200. You calculate this daily value.
Exactly. Once you have like 10 days of TR, you can get the first ATR. That's just the simple average of those 10 TR.
And after that, it gets smoother.
Yeah, then you use a smoothing formula. The next ATR is basically previous ATR times 9 plus the current TR all divided by 10. It gives more weight to recent action.
Okay, so in our example, let's say by day 10, the ATR is 215, then maybe 218.5 on day 11, and 226.65 on day 12. A slight pickup in volatility.
Perfect. Now, with those ATR values, we calculate the basic bands. Day 10, using ATR 215 and multiplier 3. The upper band might be 19,220, lower band 17,930. These change daily.
So the final step, determining the actual super trend line for the day, how does it decide between the upper and lower band?
It depends on the previous trend and the closing price. Let's say day 9 was bullish, super trend was maybe 17,850. On day 10, Nifty closes higher, say 18,650, which is well above 17,850.
Okay.
So the trend stays bullish. The super trend for day 10 becomes the low band we calculated for day 10, which was 17,930.
Ah, I see. So it uses the lower band as the floor in an uptrend. And if the price stayed above it on day 11 and 12,
Then the super trend would likely continue using the new recalculated lower band values for those days.
Yeah.
So it would rise to 80.19.5 on day 11, then 80.70.05 on day 12 in our example. Still bullish.
and that's the signal. Super trend below price, uptrend.
That's the basic interpretation, yeah. A flip from above to below price could be a buy signal. A flip from below to above, potential sell signal.
And you mentioned it acting like a stop loss.
Yes, a trailing stop loss. If you bought when it flipped bullish, you could set your stop just below the super trend line. As the line rises, you raise your stop. Helps lock in profit or limit losses if the trend reverses.
So maybe by day 10, near 18,650, initial stop under 17,930. Then by day 12, your stop is up under 18 to 70.
That's the idea. Of course, you don't need to manually calculate this every day.
Right. Charting tools, Trading View, others, they all have it built in, yeah. Just plug in 10 and 3.
Exactly. And you can play with time frames. Daily charts for swing trading, maybe shorter like hourly or 15-minute for intraday signals.
Though probably wise to combine it with other things, support, resistance, maybe volume.
Definitely advisable. No indicator is perfect. Super trend works best when the market is actually trending. Sideways markets can cause false signals or whipsaws.
So risk management is still king. Standard rules apply.
Absolutely. Don't bet the farm. And backtesting, seeing how it performed historically on the Nifty, is really crucial before trading live. You can tweak settings, but 10 and 3 is a common starting point.
Okay, so wrapping up our example, we saw a potential buy signal on day 10, with the super trend moving up nicely to act as that trailing stop. Seems quite user-friendly, really.
It is, especially in a trending market like the Nifty can often be. It provides clear visual cues. Worth exploring on a demo account for sure.
Definitely. Check it out on a chart, see how it behaves. Which brings us to a final thought for you to chew on.
How might actually using a volatility-based indicator like this, one that adapts to the market's energy, change how you look at trends and, well, make your trading decisions? It's a different lens, isn't it?